There's no doubt in my mind, everybody, that there is a world of opportunities in growth over the next 10 years. And look, the goal of my presentation today is to leave you similarly convinced. When we were putting this together in 20 minutes, I think I could have covered any of the strong thematics over the next 10 years that we've been looking at and just covered them in 20-minute increments. But, you know, so there's everything from AI to cloud to cash to card to the effects of environmental change and the winners out of those. But I'm just going to focus on two today. And luxury is the new black is essentially the rise in demand for luxury goods. And go digital and go home, or go home is the ongoing digitalization of the global economy. What I'm going to start off with first is luxury is the new black, but let's just set the scene first. So this is a sobering view of US demographics. So the red line is the top 0.1% of the population by wealth, and the blue line is the bottom 90% by wealth. And so that's a pretty sobering view. That is, the wealthy, the very wealthy, the uber wealthy have not been this wealthy since the 20s. Yeah? And you can see a substantial hollowing out of the middle class in Europe, in the US. So what you've seen is jobs that have been outsourced, offshored, sent to the gig economy. But the uber wealthy are getting wealthy because they've had most of the wage rises. They've had asset inflation funded by cheap debt. And they're buying luxury products like they've never before. Let's just look at the next part of this. And this is setting the scene of the USA versus Western Europe. So once again, the red line is the top 1% by share of national income. The blue line is the bottom 50% in this case. And so what jumps out at you there is that the wealthy have just been wealthy for years in Europe, but there's been this rapid rise in wealth in the US over the last 30 or 40 years, and a drop in wealth relatively for the bottom 50%. And so this comes as no surprise when we're talking about the luxury market, that a lot of the luxury manufacturers are in Europe, and now they're growing because there's the rest of the world to sell to. So they're selling to the Middle East, they're selling to the USA, and they're also selling to Asia. And let's start with the most iconic of those luxury brands, Ferrari. So this is a club for rich guys. I'm even going to start by asking you who's got a Ferrari in the room. That's just too embarrassing. But if you are a Ferrari owner, you probably want to stand up and shout about it. This is a company that just has so much loyalty and such long waiting lists. And what we love about it as an investment is we look at periods like the GFC where their order book came off 4% compared to about 40+%, 40%, for their major competitors. And so that gives us that element of capital preservation we really like. What's really good about this in terms of the long-term tailwind is that that high net worth income group that buys Ferraris, that sector or that segment is growing faster than Ferrari can build cars. So this is a car manufacturer that manufactures just a few over 10,000 cars a year. There's only 200,000 Ferraris in existence. That's since they started building them. They've got capacity for 15,000. And they're at a sweet spot at the moment because they're not actually covered by emission controls at the size they are. They will in the future, but it allows them to produce incredibly powerful engines. So, as I said, incredibly long waiting lists, up to 2 years, longer for some of their sports models. And this is evidence that this is a business that can extract maximum margin. So the big release was the hypercar. They sent out a key in a box to their absolute premium owners, people who had strings of Ferraris already, they were collectors. And they said on the box, this is the key, we can't tell you the price, we can't tell you the delivery date, are you in? They sold out. And in fact, one guy in the US actually sued Ferrari because they didn't send him a key. Yeah. So this is basically the same club for women. It's the equivalent. Long waiting lists, loyal customers, and rising prices. So this is a business that's growing 15% per annum, just like Ferrari is growing 15% per annum. Terrific margins and incredible demand for high-end leather goods. So the top-end bags they do sell for 30,000 euros. It's incredible that you think that you could spend 30,000 euros, but then not so incredible when you think a man will happily fork out $400,000 for the entry-level Ferrari here in Australia. That's the entry level. That's not even one further up. That's just the Portofino. And look at how those goods have gone over the years. So that Kelly bag over 35 years has appreciated 9,500%. That's 14% per annum compound growth over the last 35 years. Who wishes that they bought a couple of Kelly bags back in all those years ago? So it's the same sort of thing. It's got these long waiting lists. Montblanc, a bit more of a recent story. So this was a near bankrupt French skiwear producer. And in 2003, change of CEO. And what he did was he changed scarcity to virtual scarcity and created a brand around that. So their top-selling jacket, the Mayer jacket, it's not $3,700. One of their jackets is, by the way, but it's about $1,800. But the bottom line is that these are just black puffy jackets, the type that you would wear, type not I'd wear, but the type that you would wear on a cold night out in New York, and they're selling for $1,800 through to $3,700 US. And what he said was, there's too many of these jackets in the stores, take them out and put them in the back room. We'll only sell them if people ask them for them. And they were deluged with people who wanted that jacket. So that's virtual scarcity. If you think about their competitors, it's a $70 Uniqlo from China. And a really seriously uber wealthy person wouldn't be seen dead in a Uniqlo jacket, would they? My family has 4 of them, let me tell you, when we went to Europe. LVMH. So this is Moet and NC Louis Vuitton, LVMH. This is a business that's an accumulator of brands. So it's wines, spirits, fashion, perfumes, cosmetics, watches, leather good, jewellery, and more. It's just acquired and in the process of completing the acquisition of Tiffany, and they'll take Tiffany up market. So this is your last chance. If you want those little cheap Tiffany playing cards or a Tiffany silver pen, they won't be available because this is once again a business that's focused on promoting luxury. I mean, many people who are buying into LVMH products are in the aspirational luxury, so they're not quite billionaires, but they're really thinking about being seen as rich, and that's why they buy these products. This is a business with the share price is up about 400% in the last 10 years, and it's building a presence in Asia because Asia is just minting new billionaires all the time. Kering is another one. You might not have heard of this. This is another accumulator of brands. This is once again focused on millennials. Kering's up 570% in the last 10 years, its share price. Its major brand is Gucci amongst all of the brands, and it was previously known as sort of an older person's brand. But what they've done is they've rebranded it as street luxury. So they're doing 1,000 to 3,000 euro bags versus the 30,000 euro bag. And they're less focused on scarcity, more personal service, but also much more focused on social media. So for example, one of their brands is Balenciaga. And there's a terrific story about them using social media. And Kim Kardashian, she turned up at a fashion show wearing sort of thigh-high Balenciaga boots and apparently not much else. And it really drove demand. I mean, I think it got a lot of page views from guys, but actually real purchasing behavior from people who really love the product. So there's another aspect of resilience to downturns. Are you getting sort of the theme here is that, you know, when things go bad, Ferrari owners don't cancel. Because if you cancel your order, they never let you back in again. You know, if you ever want that Ferrari, just take your order and pay for it on the day. And that happens with Hermes bags as well. So in terms of our investability of this, all of these stocks together, all 5, only make up 12% of our portfolio because they are reasonably fully valued. Like, we're taking a very long-term view with these. And so what you've got to think about is the capital preservation component that these stocks provide, as well as the growth, because they're doing decent growth. So what I'm going to talk about now is go digital or go home. And before I just get into that chart, I might just reflect on the 80s and the 90s. So, I mean, not all of you will remember that. Some of you are too young. But I was traveling in the US recently, and I saw a wonderful bit of television in an airport. They had a picture, they had a movie, a video of Bryant Gumbel, if you remember him. He was one of the hosts of the Today Show, and it was in 1994-95, and he was saying, so this is the Today Show's internet address. And he said to his co-host, how do you get to that? What, do you call it? Like, do you call this on the phone? It's only 1995 where people were openly wondering how to get to an internet address. Yeah? So in the 80s, if you had a business and you were good and your competitors were in another city, you had a regional monopoly. That is, if somebody wanted to actually find a price from somebody in another city, they effectively needed the yellow pages for Adelaide, Perth, or Melbourne. Who here kept the yellow pages for Perth? Who here has never seen a set of yellow pages? Exactly. So what has changed is that the internet created price transparency. It created better supply chains, and it allowed better competition, which actually has reduced prices to consumers. But what it's created is digital monopolies. So global monopolies where the norm is that the first mover advantage basically takes all or takes most. And so digitally driven markets have become winner takes most or winner takes all. So I'm just going to talk to this slide here. So this is McKinsey research that we've spent a lot of time thinking about, because it's basically saying, all of you out there, you spend 30% of your time looking at emails and responding to them. You spend about 20% of your time finding stuff, whether it's digitally or anywhere. You spend about 14% of your time collaborating with other people in face-to-face meetings, and 40% of actual work that makes money for the business. And I just don't understand. If that adds up to 100%, where are the bathroom and cigarette breaks, the informal chats, the Facebook, the Insta, the Tinder, the whatever you're using, Donald Trump following him on Twitter, or buying stuff on Amazon this evening. So here's the challenge. The challenge for businesses is to make everybody much more efficient, and they're doing that through this digital transformation. Timely information to customers, timely information to employees so they can get that information to customers, and actually workflow, working with people's workflow to make them more efficient. So let's have a look at some of the traditional players. I'm not going to spend too much time on this because actually here we have SAP. Oh, I clicked that and that didn't. There you go, SAP and Oracle. So we've taken the other side of the traditional players, and you can see the names there. We've taken WiseTech, Medidata, Aconex, Salesforce, Workday, Microsoft, Amazon, Google. If you think about this, SAP is a business it's risen 70% its share price. That's in the last 20 years. So that's less than 3% compound. That's about 2.5% compound growth over that period. Oracle's up less than 5% per annum over that same period. So you can understand why we've taken the other side, is that there is a bunch of incumbents that are trying very hard to improve what they're doing for customers, but there's another bunch who are sitting there disrupting it, and by and large, we've taken the disruptors. So let's start with one of our biggest bets at nearly 10% of our portfolio, Microsoft. Now, who actually doesn't use Microsoft? Like the Ferrari question. Nobody's really going to put their hand up, are they? No. Okay. So like Microsoft has built up business relationships over many, many years. Maybe not a personal relationship, but you've got a personal relationship with Word and Excel and PowerPoint. You might not like that relationship, but it is your relationship and you just use it all the time. Use it like air. And the reality is you're paying for that. So you're a bit different in terms of a customer from Google's customer, because you're not paying for that, or Facebook's customer. So Microsoft takes your privacy and your security much more seriously, and they've built on that. So what they've done is they've brought the cloud in behind it, and they're transitioning all of you slowly to the cloud. Now, 20% of global corporates are digitized. That's an awful lot that aren't, and there's a long runway there of work to get there. They're offering you things like end-to-end integrated identity security and compliance, and working with teams. Pinnacle's using it has over the last 3 or 4 years, and it seems like every couple of months a new bit of software comes out that actually improves our lives and makes everything work a bit more efficiently. Very impressive. So this is a business that's growing quarter to quarter, mid-teens, and we think that given that it can continue to grow like that for years, the total addressable market is huge, that it's actually on a pretty reasonable forward PE. It's on about 26 times. That's pretty good for a business that we think can keep growing for the next 10 years. And what they've been able to do that other more stable long-term businesses have struggled to do is actually take you all slowly on the journey from on-premises to cloud. Here's another business that is leveraging the value of employees in sales, service, and marketing. So we own Salesforce. You probably know it from the sales CRM, but let me tell you, it's now building in service and in marketing. And this is a business that has generated about $17 billion in sales in the last year, but it's a $100 billion total addressable market. So we think it's growing rapidly via its competitors for a start. We can see the competitors. We look at businesses like ServiceNow, and 20% per annum, that's a pretty decent growth in sales. Obviously, they're getting higher growth in profit because there's operating leverage there. Interestingly, the service cloud is going to be their biggest segment over time rather than sales, which is all about putting that power in the hands of employees to better service their customers, which keeps customers coming back. So this is another case of a business that is essentially winner takes most. Market share at about 39% in service. That's really substantial, and we think it can go further than that. So let me just go back very briefly to a story. In about 1995, I went to a conference on the Gold Coast, and they had Michael Bloomberg, who's in the news at the moment, by live video coming in for the keynote address. And at the end of that address, he was asked a question: what are the 3 big trends that you think will affect the world for the next 20 years? Now, that's a terrific question, and I found the paper that I'd written it down in one of my little notebooks. He said the 3 major trends. I'm telling you, this is 1995 when Bryant Gumbel was sitting there going, how do you call this internet address on the phone? He said the digitization of data, the global positioning system. I thought that was a pretty weird one at the time because I didn't really understand what that was, and the miniaturization of batteries. So hence, we've bought Tesla, we own it, but really it ticks a lot of boxes. It's an iPhone on wheels. There's a nod to digitization, GPS, batteries, and a touch of even the earlier luxury attributes in their cars. This is a superior customer value proposition. Who's actually driven a Tesla? 1, 2, 3, 4. You are missing out on something serious. Like, it's just in there. Just book it. Do yourself a favor. Like, it's better than going on a carnival ride. You plant your foot, and there's this sort of weird feeling in your head from the acceleration. Why would you pay $450,000 for a Porsche GT3 when a Tesla 3 worth 120 grand can out-accelerate it? Seriously, like, this is a customer value proposition that people just don't get yet. And so, the batteries are the best, the motors are the best, the digital technology is the best. It's working towards self-driving. There are real opportunities, for growth in this business that I don't think people are taking seriously, but we've been following it for 3 years. My CIO and deputy CIO own 4 Teslas between them. They're passionate about it, but we've waited until last month to buy it because the financials didn't stack up. Like you got to, obviously there's the great car and then there's there's the, buying the thing to make money for clients. But what's changed is that the cash flow is positive. The cars, they're going to deliver enough cars. The technology is really being proved. And what's amazing is the competitors are just standing in their wake. If you want to think about it, it's a bit like when the iPhone came out and everybody was prepared to pay much more for an iPhone than every other competitor, and Apple has basically sucked all the profit out of that market. So this is a small weight in our portfolio, as you'd expect with Hyperion. We go in low and build up. So I come to my last slide. This chart represents the last 5 years with our global fund. And we've had 23 years with our Australian equities fund. And it's been a great 5 years. Like, clients have done really well, and we're thrilled about that. But what about the next decade? So firstly, the uber wealthy don't look like giving up their position anytime soon. Like, that's all just a one-way street for some time to come. Luxury businesses continue to manage scarcity well, and they all trade on seriously high returns on it. They all, show very high returns on equity. These businesses are 30% ROE businesses. They're maintaining that. They're reinvesting at a rate your clients can't possibly do. The growth in the digital economy is breathtaking. So the total addressable markets are really large, and I'm not even covering things like cloud computing, which has just got $1 trillion addressable market, total addressable market. So the Hyperion view, just to sum up, is that dependable long-term growth is actually still quite hard to find, and that many low-quality incumbent businesses will actually struggle over the next 10 years because they're going to get disrupted. And in fact, some of those businesses that get disrupted will just go broke. But that won't preclude a world of opportunities for growth as long as you know where to look. Thank you very much.